Hey there, folks. Franklin Green here, your trusty guide to the world of money and investing. Welcome back to The Money Frog. In today's video, we're going to take a deep dive into a crucial topic for anyone looking to build wealth: investments. You've probably heard this term a lot, but what does it really mean? In this video, I'll break it all down for you, from what investments are to why they're important, and how to start your investment journey. So, if you're new to the world of investing, or just looking for some solid advice, you're in the right place. Let's dive in. What are investments? All right, let's start with the basics. What exactly is an investment? At its core, investing is the act of putting your money into something with the expectation that it will grow over time. Unlike saving, where your money just sits in a bank account, investing means your money has the potential to increase in value. And the best part? There are lots of ways to invest. Some common examples include stocks, bonds, real estate, and even small businesses. In essence, investments are assets that you put money into with the hope of earning more money in the future, whether it's through price appreciation, dividends, or interest. Why should you invest? Now, you may be thinking, why should I invest my money instead of just saving it in a bank account? Well, let me tell you, there's a little thing called inflation. Inflation happens when the price of goods and services rises over time, and it's one of the biggest reasons why just saving money in a low-interest bank account can hurt you in the long run. For example, if you save $1,000 in a bank account that earns 1% interest, your money might grow a little over time. But if inflation is 2 to 3% annually, that means the purchasing power of your $1,000 will actually decrease. So, investing is a way to outpace inflation and help your money grow at a faster rate than simply saving it. Investments with the right strategy can help you protect and grow your wealth. Types of investments. Let's talk about the different types of investments. There are three main categories you'll want to understand when starting out: stocks, bonds, and real estate. Each has its own level of risk and potential for return. Stocks. When you buy stocks, you're purchasing a share of ownership in a company. If the company does well, the value of your stock increases, and you can make money through capital gains or dividends. However, stocks are more volatile and can lose value in the short term. Bonds. Bonds are essentially loans that you give to companies or governments. When you buy a bond, you're lending them money, and in return, they pay you interest over time. Bonds are generally considered safer than stocks, but they offer lower returns. Real estate. Investing in property, like houses or apartment buildings, can be a great way to build wealth. You can make money from rental income or by selling the property at a higher value in the future. Like bonds, real estate tends to be less volatile than stocks, but it requires a bigger initial investment and more hands-on management. All of these investment types carry different levels of risk and return, but the key is to diversify. Don't put all your money into one type of investment. Risk versus reward. Here's a concept you'll need to get comfortable with: risk versus reward. When it comes to investing, the potential for reward is usually directly linked to the level of risk you're willing to take. Stocks. These can be high risk, but they also offer the potential for high rewards, especially if you invest in companies that experience rapid growth. Bonds. These are typically safer investments, but they come with lower returns. They are more predictable, but they may not give you the big gains you're hoping for. Real estate. Real estate is often seen as a moderate risk investment. It requires a larger upfront investment, and property values can fluctuate, but over time, it can provide a stable return. The trick is to balance risk and reward according to your goals, age, and financial situation. If you're young and have a long time to invest, you might be more comfortable with the risk of stocks. If you're closer to retirement, you might prefer safer investments like bonds or real estate. How to start investing. All right, so now that you understand the basics, you're probably asking, how do I start? The first thing you should do is educate yourself. There are plenty of resources available to learn more about each type of investment, and understanding how each works will give you the confidence to make smart decisions. One option is to work with a financial advisor, someone who can help guide you through the process and create an investment strategy tailored to your goals. But if you prefer a more hands-on approach, there are investment apps and platforms that allow you to start with small amounts of money. Apps like Robinhood, Acorns, and Stash make it easy to begin investing even with a small budget. Start small and don't invest money you can't afford to lose. It's better to begin with manageable amounts and increase your investments as you learn more about the process. And always remember, investing is a marathon, not a sprint. The power of compounding. Here's a powerful reason why you should start investing as early as possible. Compounding. Compounding is when the returns on your investment start to earn additional returns. Over time, this can lead to exponential growth, which is why the earlier you start, the better. For example, if you invest $1,000 and earn a 7% return each year, after 10 years, you won't just have $1,700, you'll have nearly $2,000. And after 20 years, that same $1,000 could grow to over $3,800. This is the magic of compounding. It's why the earlier you start, the more your money will work for you in the long run. Before we finish up, here are Franklin's golden tips for beginner investors. Start early. The sooner you start, the more you can benefit from compounding. Diversify. Don't put all your eggs in one basket. Spread your investments across different areas. Be patient. Investing is a long-term game. Don't expect to get rich overnight. Only invest what you can afford to lose. Never invest money that you need for immediate expenses or emergencies. And that's a wrap, folks. Now you've got the basics of investing, and you can start your own journey toward financial success. Remember, investing isn't about getting rich quickly. It's about making your money work for you over time. So take it one step at a time, and don't forget to stay patient and stay focused on your long-term goals. If you found this video helpful, make sure to hit that like button, subscribe to The Money Frog, and ring the bell so you don't miss any of our future financial tips. Got any questions or tips of your own? Drop them in the comments below. I'd love to hear from you. Until next time, stay smart, stay savvy, and keep hopping toward financial success.